As I discussed in my video 2 weeks ago, there's a fairly safe way for you to make 50% to 100% or even more on a 1 to 3 year long trade using safe U.S. government Treasury exposure. U.S. government Treasuries are thought of as boring, low return, but very safe investments. But in this case, they're presenting a rare opportunity to make very good returns while protecting your portfolio from downside equity risks. Typically, U.S. government Treasuries act as a balance to the equity risk in your portfolio. If you've watched my videos on the ideal portfolio, you'll know exactly what I'm talking about. I beat this drum all the time. Under normal circumstances, when there's a flight to safety, Treasury long bonds go up very quickly as equities drop. This counterbalance creates a nonlinear effect in the long-term performance of your portfolio. As you can see here, you can see that the portfolio, this big white bubble, is outperforming all of the components, certainly in terms of maximum loss, and you're getting almost all of the return of the highest risk equity component, which is the NASDAQ 100 here. So this is not obvious to people, and it happens over the long term. But when equities drop like a rock, this TLT 20-year Treasury ETF will typically shoot higher and offset some of the risk in these two asset classes. And the net result is, over the long term, you end up with very good portfolio performance. In this video, I'm going to discuss the time frame over which you should expect to see good returns from this strategy. Now look, the Fed hasn't started lowering rates yet. As you can see here, this black line is the current Fed funds rate. It's stuck up here at 5.5%, but they will most likely have to start lowering rates at the next Federal Reserve meeting 1 month from now in September. As with any investment, patience will be the key to reaping the potential upside in this strategy. We're quickly approaching the time for Treasuries to move higher over the next 1 to 3 years. Now you're probably asking, but how can I get 50 to 100% returns from safe Treasury bonds? As I discussed in my previous video, we're being presented with an opportunity that might not come around again for many years, if not decades. In this rare instance, exposure to long Treasuries through a leveraged ETF like TMF presents the opportunity for very large upside moves with limited exposure to downside risk. Look, this doesn't mean there's no risk, and you should absolutely consult with your financial advisor and do your own analysis before investing in this shorter term, let's call it 1 to 3 year, opportunity to potentially make outsized returns while protecting your portfolio from downside equity moves. So why does this trade present unusual limited downside along with large upside potential? Well, we're sitting at an inflection point in the interest rate cycle where the Fed is now going to be forced to lower rates to head off a bad recession. How much they lower rates is anyone's guess. But even if they just lower rates to more normal levels, you can see the potential for TMF to move substantially higher in the coming months or more. And the best part is, while you're waiting for this trade to move higher, the U.S. government Treasury exposure in your portfolio will offer protection from downside moves in equities. This positions you for higher returns with lower risk over the coming year or more. Every week, I try to bring you videos that explain what's going on in the markets and how to manage the risk in your portfolio. And from time to time, I produce videos on portfolio construction and other topics that might be of interest to you. Please leave your comments below and let me know what you think of this opportunity in TMF. Am I kidding myself, or does this have potential large upside with limited downside? If you found this video useful, please hit the like, subscribe button, and share this video with your friends and family. And as always, I appreciate it when you leave comments down below. With all that, let's go through the current health of the stock, bond, gold, and crypto markets. Let's go through the markets. So wow, over the past week, we've had a very nice move higher in equities. And you can see that ARK Innovation is leading the way, followed by the NASDAQ, followed by the S&P 500, followed by small caps, and finally, in dead last, is the Dow. This looks really good. This is a very healthy appetite for equity risk. And if we look over the last month, you can see there's been a struggle, but now things are starting to come back. Year to date, NASDAQ still leading the way higher. ARK Invest is in dead last, but it's really shooting up higher. If you look at the slope of this, it's moving up very quickly compared to these other indices. And then if we look back over the past year, you can see a similar picture. But ARK Invest is actually above zero if you go back a year, almost up 10%. And how does this all show up in the bottom dynamics? Well, we've had kind of an interesting run here. We had somewhat of an attempt at a bottom forming indication here. The bottom forming indicator, this orange line, didn't get up high enough. And in general, it's not going to. When you're in between major bottoms and major tops, it's going to approach a bottom forming indicator, but not quite get there. But you can see that the equity markets, the S&P 500, bottomed out here. And then it started to move higher. And as it moved higher, the bottom confirmation signal started moving higher, and you can see the confidence level is moving higher. This tells me there's a herd behavior starting to happen here in this upward move. That's very positive for equities. And what about risk versus opportunity? Well, this was getting a little bit scary here. You can see that risk acceleration was well north of 70, approaching 80. And thankfully, recently, it really started to collapse. Now, what I don't like here is that the opportunity acceleration is also collapsing as the opportunity level is also falling. So we're going to have to wait and see here. This is not a signal to me that we should, take off risk and move some assets into safety. We've got to see how this plays out going forward. And I think a lot of this was caused by the carry trade unwinding several weeks ago when this market really tanked and dropped back here and then started to rally. So this may just be a one-off situation caused by that carry trade event. And what if we look at equity versus safety? Well, let's jump right into the overlays. You can see what we've got here. Small caps were right up here in first place, ranked first, and they're now dead last. And you can see they're followed by the NASDAQ, followed by the S&P 500, and then the Dow Jones Industrial Average is ranked the best out of all the equities. This is a flight to safer Dow stocks away from small caps and NASDAQ. So not a great look, and it's not a great look that all the equities are down here in 7th, 8th, 9th, and 10th place. You can see that all the safety assets are ranked up here in the top rankings. So we've got long duration. In fact, let's just jump to safety assets. So if we look at this, we've got the longest duration treasuries ranked first, 20-year bonds second, gold third and moving higher here, intermediate treasuries fourth, cash fifth, and short duration treasuries sixth. So this is a healthy appetite for treasury risk, but I'd like to see these equities start moving up here and moving these safe haven assets down. How does all of this show up in the buying and selling pressure? Well, you can see what's happened here. We have a very nice movement in the buying pressure, this solid gray line for the Dow, along with a very nice price move higher. And you can see the selling pressure, this orange line, has just collapsed. Now, if we look at the S&P 500, again, very nice move higher in the price and the buying pressure moving higher. NASDAQ 100, same picture. Price moving higher, selling pressure collapsing, buying pressure moving higher. And then if we look at small caps, same picture. Price moving higher, selling pressure moving lower, and the buying pressure moving higher. Not as drastically as back here for the Dow Jones Industrial Average, though. And if we look at ARK Invest, again, similar picture. You've got the price moving higher and the selling pressure moving lower, buying pressure moving higher. So this looks really good going into next week. Now let's take a look at sector rankings. Now these move very slowly, so I'm just going to put these up here. If you want to look at them and analyze them, go ahead and pause the video and take a look. But let's jump right into the sector rank acceleration, because these kind of give you more of a sense of where the market's headed rather than where it's been. Let's put the overlays on. So what looks good here? Well, there's a fair amount that looks good here. I don't know if you remember my video from a couple of weeks ago, but there wasn't much here at all. In fact, there was almost nothing. And so this is a big improvement from a couple of weeks ago. We've got all of these sectors either moving up or staying flat. Consumer staples, I put a green and a red line because it's a green line because these are equities and they're moving higher. It's a red line because they're safer equities and they're moving higher, and they're up here above consumer discretionary. So kind of a mixed thing here. But this overall is starting to show some promise. Now, what looks bad? Well, there's a fair amount, but not nearly as bad as 2 weeks ago. You've got gold moving higher. You've got cash moving higher. Again, consumer staples moving up. Emerging companies, small cap stocks move down a lot. You've got the Dow Jones moving down a lot in the rankings here. You've got S&P 500 moving down. And you've got NASDAQ 100 moving down. And you've got XLK, which is technology, moving down. So there's a fair amount of, let's call it negative stuff here. But this is definitely an improvement from 2 weeks ago. And what about treasuries? Well, just like equities, you can see that treasuries had a very nice week with the longest duration EDV up here the most, TLT 20-year second, and so on. So this is a very healthy appetite for treasury risk. And if we look back over the past month, you can see we've had a very nice run higher here. What about year to date? Well, you can see where we were and you can see where we're headed. So this is continuing to improve, and I believe will continue to improve, especially as the Fed lowers rates. And we'll talk about that later in the Fed rate monitoring tool. And then if we look back over the past year, you can see it's been a wild ride, but net, we're up over the past year. So this is an improvement from where we've been. And how does this show up in the buying and selling pressure? Well, you can see short duration treasuries have been moving higher, and the buying pressure is above the selling pressure just slightly. Intermediate treasuries, again, moving higher, buying pressure well above the selling pressure. And then 7 to 10 year treasuries, which I call intermediate to long, again, price moving higher, buying pressure moving above the selling pressure. And then if we get to long duration treasuries, again, price moving higher, and the selling pressure is falling, the buying pressure is moving higher. Now I want to focus in a little bit on the 20-year bonds and what's happening here. So you can see, I put these green arrows on here, you can see that clearly the price has been moving higher. In fact, it's been moving higher since back here, but I want to look at from this point forward in general. And we could put a green arrow here just as well, but I think you can see that pretty well. But if we look at the buying pressure, this solid gray line, you can see that these peaks are getting higher each time. That's very positive. And you can see that the valleys for the buying pressure have been moving higher. So this really looks good for TLT. Now, what if we look at the selling pressure side? Well, on the selling pressure side, this peak is lower than this one. So this is positive. And this trough is much lower than these previous two. So I like this. While the price is going higher, this looks really, really good and supports this price move very well. And what about that inverted yield curve? Well, hopefully soon we won't be calling it an inverted yield curve. You can see that we're 17 basis points inverted, and you can see what's been happening here. The light blue line is where yields were a year ago. The red line is where they were a month ago. And the blue line, the dark blue line, it almost looks purple on my screen, is where they are now. You can see how yields have dropped from 5.35 to a month ago 4.867 to now 4.497. So yields at the short end are dropping. And once the Fed starts lowering rates, these should come down even more quickly. And speaking of the Fed lowering rates, if we take a look at the Fed rate monitoring tool, the first thing you'll notice if you've been watching my videos every week is there's no blue line here. The blue line is where interest rates currently are, which is at 5.5%. There is no blue line. So the markets feel there's 0% chance that the Fed's going to leave rates where they are. In fact, there's a 75% chance they'll lower them by 0.25%, and there's a 25% chance that they'll lower them by 0.5%. Now, if we get out to November, you can see that this bar goes away. There's a 62% chance that the Fed will lower rates by 0.5%. There's a 33% chance that the Fed will lower rates by 0.75%. And there's a 4% chance they'll lower them by 1%. Now, if we move out to December, it gets really crazy, right? Because now it's very likely that the Fed will lower rates by 1% here, 0.75%, 1%, 1.25%, and even 1.5%. So rates are expected to come down dramatically through the end of this year. And as rates come down, the price of TMF is going to move substantially higher. So what's up with gold? Boy, gold has been moving higher here over the last couple of months and is shooting higher here. Now, several weeks ago in one of my videos, I talked about the fact that the selling pressure was up here at sort of a high, unsustainable level, and that gold was likely to move higher, which it did briefly. Then it tanked again, and the selling pressure went even higher. So I didn't do a video last week, but if I had, I would have said that, boy, it's likely gold's going to move higher, and it certainly has done that. And you can see that the buying pressure is moving higher. I don't know where this is going to end and where it's going to go. Gold is a tough thing to trade. And what about Bitcoin? Well, Bitcoin, a very similar picture. We had selling pressure back here, very high, and I said it was likely that Bitcoin would move higher. It did. Now we've got selling pressure very high here, up at 10. That's not sustainable. You can see that it's been collapsing, and the price did move somewhat higher. Now, I'm not saying the price is going to continue moving higher because the buying pressure is falling and the selling pressure is moving higher here. As you can see from the price movements and the metrics we've been looking at for equities, the equity markets are trying to recover and move higher after their recent pullback, with ARK Invest's ARKK Innovation Fund and the NASDAQ 100 leading the way, and Treasuries have been rallying nicely from their recent pullback. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.